Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Jonathan Ferro, along with Lisa Abramowitz and Anne-Marie Hordern. Join us each day for insight from the best in markets, economics and geopolitics. From our global headquarters in New York City, we are live on Bloomberg Television weekday mornings from 6 to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app. Terry Haines of Pangea Policy. Terry, welcome to the programme. There is always a temptation to move on to the next thing. I just want to talk about the last thing for a little bit longer. Just frame what we witnessed over the weekend. To see a European Commission president accept 15% and essentially say thank you, we will rebalance, and almost apologising about the situation.
Well, it's a triumph of a lot of things. Certainly, the president ought to take a victory lap. I think it ends up being good for the European Union. It's a blow against the conventional wisdom, which, of course, in the last quarter saw a lot of this as disastrous. The markets see the fact of the deal and the ratification of trade and the expansion of trade as the most important thing. And number one. Number two, I think there's a situation here where, as you've alluded to in your question, with Tyler, that the geopolitical element of this also remains front and center, whether we're talking about the continued interdependence of the U.S. and European Union economies, or whether we're talking about investments in the United States and purchases of military equipment. You're seeing a tightening of the alliance, and I think, frankly, an attempt by both parties to push back a bit against China.
Terry, just to build on that theme, we're hearing from the EU Trade Commissioner, Maros Sefcovic, this morning in Brussels, and he commented on how overcapacity is destroying the EU steel industry. Overcapacity is sort of code from steel from China, and I wonder how much that is ongoing discussions that are happening now that have pushed Europeans to make this deal with the United States, even if it's being perceived by the market as being better for the U.S.
Well, they'll certainly try to make a deal on this, but at the same time, Europe sees and the United States sees as well. I think the China using economic sectors and industries as geopolitical weapons, and there's nothing more stark than China trying to flood the European market with EVs, for example. On this, and we even see, as Bloomberg reported recently, Starbucks under assault now by a Chinese coffee company starting in New York, vastly undercutting prices. So you'll see this, throughout, and it is a leitmotif of these trade deals and the fulcrum of kind of pushing back against China, limiting China's ability to try to use industries and sectors to, frankly, hollow out and destroy industrial capacity in the West.
What have we learned from both the Japanese deal and the EU deal in terms of the structure of the sustainable trade conversation going forward? Is it that 15% is the new floor and that you have to have some sort of investment fund alongside that, the details of which haven't really been disclosed on either side?
I tend to go outside in on this instead of inside out. What I mean by this is I think markets, and I've said this many times on this program, I think markets are focusing entirely too much on tariffs and entirely not too much on the broader benefits of the rest of Trump trade policy and tax policy, whether it be the tax bill and the variety of things that are coming from that, or these trade deals and how they're trying to reorient in ways that frankly continue and expand investment in the United States as a complement to onshoring and reshoring in critical industries, Terry, as Secretary Bessent puts it.
In fairness, though, stocks are at record highs. They've been reaching record high after record high. In what capacity are you saying that markets are not aware of some of the positive benefits from this?
Well, I'm saying that they haven't been, first of all. And second of all, I'm saying that there continues to be a focus on tariffs as a negative without the countervailing positives and attached. certainly markets had gotten over a lot of the tariff shock in the last quarter and got past the idea from the conventional wisdom that this was going to cause a hole in the economy. Now your situation is, I think Steve put it very well in the last segment, is you've got a variety of hoops that have been jumped through, all of which are market positives, and now we're turning to, for example, the Fed this week as well as earnings to see if the proof's in the pudding on that side.
The narrative has changed quickly. Let's put it that way. Terry, appreciate your time. Terry Haines there of Pangea Policy. Steve Ricchiuto of Mizuho with a bullish forecast for Friday's payrolls report, calling for 140,000 jobs to be added and expecting the unemployment rate to tick up slightly. Steve joins us now for more. Steve, good morning.
Good morning.
The sign of the times that maybe 140 is called bullish now for the labour market. What's changed?
Well, you are further into a business cycle. You do have a labor market shortage. You do have a very, very tight labor market. So it's hard to continue to add large scales without causing a certain amount of disruptions and a dramatic rise in wages. And I think companies have been resistant on that. I also think there's a bit of a technology shift taking place. I don't think it's all the AI, but I think it's further adopting of the traditional types of technology that we need to do things in the service industry, with more and more kiosks popping up everywhere. And I think that helps the situation as well. So we're supplementing labor or get a little bit with capital where we can.
You have some people like Chris Waller, governor, who's expected to dissent, the first dissent on the Federal Reserve since 1993, potentially on Wednesday, coming out and saying he's seeing cracks, he's seeing signs that there is instability in the labor market. Do you reject that wholesale, or do you just say that that is something that comes along with the changes in technology and demographics?
Well, I do reject it wholesale, because what we see in terms of the claims numbers, what we see in terms of the continuing claims numbers, leave us in an environment in which, there's a healthy labor market environment. We see no evidence whatsoever in the data that's less likely to be disrupted by any kind of flow differentials. We also see it in terms of the JOLTS numbers, which I don't particularly like, but the Fed seems to like, in terms of hiring, quits going back up, in terms of hirings being healthy, in terms of job openings going back up. So I don't see where there really are cracks in the labor market. It's a traditional slowing that takes place as you get this far into an environment, and, oh, by the way, adjusted for how tight the labor market fundamentally is.
Given the fact that we do see some sort of slowing, at the very least, is there anything inflationary about this labor market? Is there anything about wage growth that would give you confidence that we could see more than just a one-time price adjustment from tariffs? Oh,
I think you're going towards a 3% inflation rate, and that's part of the issue. I think it's from a labor market tight standpoint. I don't necessarily have to talk about tariffs to tell you I think we're going to 3% inflation. And I question whether or not tariffs themselves will be reflected in prices substantially, because you look at, importer margins, they're very, very wide. You look at exporter margins with the dollar going down, you've got that benefit coming through. The little bit of goods prices we've seen, given the fact that the dollar has depreciated 6 or 7% in the last year, not surprising you see a little upward movement in prices that would typically just take place from the currency standpoint. And actually, it's not even keeping pace with the currency standpoint, because global deflation is real. And that's the other thing that's offsetting and helping the exporter margins widen, because as China dumps all its goods everywhere else in the world, these people are sitting there with their raw material base starting to get cheaper, and therefore they could absorb the margins more. And China is dumping goods everywhere that they can't dump here anymore.
Overcapacity is a massive issue, particularly for the Europeans, that's for sure. You said something really interesting that we need to unpack. The labour market might be a reason to be hawkish still. Governor Waller was in your seat a week, 2 weeks ago, and made the case that the labour market is increasingly becoming a reason to be dovish. So I just want to give you some time. What's happening in the labour market right now that you think is going to keep them on the back foot?
I think the fact that the unemployment rate is not going to go higher. I think the movement to 4.2, we've been there and they've done nothing. But I think when you look at the fundamentals of the labor market and what will drive that unemployment rate up a little bit, you're going to discover that it's positive signs, an expansion in the labor force from not having expanded for 2 months in a row. That's going to be the kind of thing that gives you an environment where, and that's probably going to wind up in a little bit increase in unemployment temporarily. You're going to wind up in an environment where it's a healthy expansion expansion in the labor market, healthy upward adjustment in the unemployment rate. I don't think there's cracks in the system. When I look at the earnings numbers, my earnings revision tracker is now positive after being negative for weeks on end. It's now been positive for 3 weeks in a row. Companies are revising up earnings. We're at 10.9% for this year, 13.9% for next year. These are solid earnings numbers. These aren't kind of an earning number where people sit back and say, I have to scale back on employment dramatically. And I think a lot of the announcements that you're picking up on in the labor market are taking place in states where you're required to announce the layoffs, but you're not required to announce the net hirings. And I think that becomes part of the problem. It's selective decision to look at the information, and this is a confirmation bias I think comes from the dots. If I were to drop Jonathan Ferro out of an alien spacecraft, you had been studying the Federal Reserve for years, you'd been studying the U.S. economy for years, but you didn't know anything about the dots, and I dropped you in Arizona right now, okay, you would come out of that spacecraft and you would be like, oh, the Fed shouldn't be cutting rates. But everyone else says the Fed's cutting rates. Why? Because the dots are there. So everyone's biased by the dots.
Other people might cherry pick some labour market data right now. Lisa's talked about a few things. Entry-level hiring, not great at all. Job switchers, not getting that boost to pay. You talked about the labour market and the tightness there. Sufficiently tight to generate stronger payrolls growth, stronger wage growth that keeps this Fed reluctant to cut interest rates?
We've got an hourly earnings number of 0.4%. That's, again, consistent with a 4% rise. A 4% rise is consistent with 3% inflation. Fed's target's 2. We're at 2.7, our estimate for the upcoming PCE deflator. They're 7/10 off the mark, 3/10 closer to my number, 7/10 away from their number. I'm sorry, I think they're not in the position to cut rates. And if they were to cut rates, I think it would be a mistake. And I think you'd discover exactly what happened last year when they cut rates, and that is the long end of the curve would sell off. So it would be a bear steepener.
Which at a certain point is the reason why people are also looking to the auctions. Sorry, I had to say that. I've been remiss. There are auctions today and tomorrow, 2-year, 5-year, and 7-year notes, but also the Treasury refunding announcement that comes on Wednesday, when maybe we get a sense of whether any of this will matter for the U.S. government's debt financing costs, because maybe they'll issue everything in T-bills and just retire all of their coupon, all of their Treasury bonds. I mean, how much are you looking at that to really understand exactly how this Treasury Department is going to manage this and whether it's going to have any market ramifications?
Well, I think there's lots of reasons to expect bill issue sizes will go up. Back when I began, which was ancient history in terms of the market, one of the things I had to do was estimate the Treasury's operating cash balance. So I had to figure out financing and how to figure out the net cash flows. And we assumed every single quarter, a third of all the net new money would be raised in bills. That's not happening now. So yeah, there's more bill issuance coming relative to coupon issuance.
When you came in, you said that there's something else that you're looking for.
Well, stablecoin is something that I'm going to be looking to see whether or not Treasury Secretary Besson, if he's back from his overseas trip, and talks further about stablecoin than he did at the May refunding announcement. And he made a statement at that point in time that I think is stuck in a lot of people's minds, and I've visited a lot of accounts. And some of these accounts are very, very interested in the whole stablecoin concept. And where do we go with stablecoin, and how much of it will be financed through bills? And he talked about $2 trillion market cap. You look at stablecoin now, it's about $300 billion. So that's telling you there's a long way to go. And I question whether or not, if you wind up with it being done properly, if you wind up, for example, the Federal Reserve issuing its own stablecoin, could you then be in a situation where we might actually replace a lot of our electronic transfers of wires and replace the SWIFT system with something more simple and less costly for the end result user? And I know the banks don't want this because clearly it influences a business they make a lot of money on. But clearly the end user wants it. I can imagine a place like Walmart, Target, Boeing, these big people, these exporters, these importers, all sitting there saying, this would be great. It reduces my costs. I really think we have to do this. Right now, we've got lots of stable coins going in different directions and trying to do different things. If we could find one way of unifying it and putting them all on one network, or creating it all in terms of one large ability to do it, for example, with a Treasury coin hosted on a Federal Reserve website, I think you could get a very fast adoption of the technology.
Do you think it leads to increased T-bill demand?
I do think it leads to increased T-bill demand because I do not believe it'll affect currency in circulation, which affects the rest of the Federal Reserve's portfolio. Currency in circulation as a percentage of the economy, as a percentage of financial transactions, is not going down. Yes, a lot of the currency in circulation is outside the country, but we still have the currency that's in circulation winds up outside the country. But we do have, as a result of that, the big Federal Reserve portfolio, and I don't think it changes. So yes, what happens in terms of stablecoin, I think will be a net new demand.
Interesting. Happy to catch up with you this morning.
Cheers.
A lot of the audience writing in as well. Steve Ricchiuto of Mizuho having a tremendous year so far, dead on so far this year on a lot of issues. The world's most watched football league making its way across the Atlantic. The English Premier League is playing 6 matches for sold-out crowds in New Jersey, Chicago and Atlanta this summer. The series kicking off this past weekend with Manchester United beating West Ham. Joining us now, I'm very pleased to say, the CEO of the English Premier League, Richard Masters. Richard, good morning.
Good morning. Thank you for having me.
Welcome to the studio here in New York. It's good to see you, sir. Let's just talk about your involvement in the sport. I think it's almost 20 years of direct involvement with the Premier League. Are you surprised by the amount of growth we've seen? Not in the UK, forget all of that. The amount of growth we've seen in America.
Yep, 20 years next January at the Premier League, 7 years as CEO in December. Watch the Premier League get bigger and bigger and bigger. And out here in the US, we've got a fantastic broadcast relationship with NBC. We've opened offices here in New York. We're committed to growing the game. About 30% of the US population are interested in soccer or football, and about 2/3 of those follow the Premier League, and that's a brilliant foundation from which to grow. That's the reason we're out here with 6 of our teams playing matches to give our fans a taste of the Premier League.
As a Brit in New York, I can tell you the experience of NBC is amazing. I get to wake up on a Saturday morning, on a Sunday, and I get to watch absolutely everything. That's not the experience in the UK with Sky. It's a very different experience. You only get to watch so much. Why do we get to see so much more through NBC than maybe fans in the UK get to see at home?
Well, in the UK, the matches between 2 and 5 o'clock on a Saturday afternoon, which is the traditional time to go and watch football in the country, aren't broadcast. So it's not just the Premier League, the EFL as well, aren't broadcast. That's part of the decision we've made. It's a long-term commitment to what's called Article 48. But anywhere else outside of the UK, it's all 380 games throughout the season you can watch. And of course, here in the US, as you say, there are millions of people getting up on a Saturday and Sunday morning, watching their favourite team, and you can sit there from 7 a.m. till lunchtime, watch the entire thing if you want to. And that's a brilliant thing for us.
Does it kind of hurt your soul to say soccer instead of football?
Not at all. I think they're interchangeable. When I grew up in the Midlands, I watched Soccer Sunday on Star Soccer, rather, on a Sunday lunchtime. So it's interchangeable.
Yeah, at this point, though, does it dilute the player's ability to really commit to not only a team, but a season if they're playing at all times, in all places, and their bodies have to be exhausted at a certain point, no?
That's true. I mean, there is a strata of players at the top of the game who are playing a lot. And it's a big issue within the game. The Premier League, obviously, since '94 has been 20 clubs, 380 games, August to May. But we've seen the gradual expansion of European competitions and now global competitions as well. Next summer, the US will host the World Cup. It's the first time 48 teams, and of course, in the last summer, we've seen the Club World Cup, a brand new competition put into the calendar. And I think that, from my perspective, not just as CEO of the Premier League, but also my other role as chair of the World Leagues Association, which is about representing domestic leagues around the world, there has to be a big conversation now about how you balance this out properly and make sure that players are looked after and that these competitions are additive and not subtractive from the competitions they bump into.
Well, let's have that conversation right now. I can speak as a fan. I hate it. I don't want to see an expanded FIFA Club World Cup. In fact, for most fans of the English Premier League, we get annoyed whenever there's an international break. We don't want to see more tournaments. What we loved was just the cadence of every 2 years. You had a major tournament, the Euros, the World Cup, the Euros, the World Cup. Why have we gotten away from that? And what's your message to FIFA, to UEFA? As in the minds of many fans, they just seem to be chasing money at the expense of the game and maybe the players' health.
Well, the message is talk. There is actually strong dialogue between domestic leagues in Europe and UEFA about competitions, and that's a coalition of stakeholders, clubs, leagues, players as well, talking about it. That dialogue doesn't happen at the top of the game, and it should do. So that's the key message. Sit down and talk to the leagues, talk to all the stakeholders, and find a way through all of this, because it has a limit. And I think we've gone past it. We've gone past saturation point. My job, obviously, is to look after the Premier League. And we're going great guns, thank you very much. And I want the purity of that competition to remain. I want people to be able to enjoy their football, because I want the best players on the pitch all the time in the Premier League, and not worrying about how to balance everything out.
Let's talk about the purity of the game. It's a polarising topic and very controversial, as you know. Manchester City in this number 115, the number of charges for alleged breaches of financial regulations. What can you share with us this morning about where things stand?
Nothing is the honest truth. The case was heard last year, and we wait for the decision to be made. We can't hurry the people whose job it is to make that decision, and it will happen when it happens, and I don't know when it's going to be. We'll find out with everybody else. What's your sense of why it's taking so long? I don't know, and it's difficult for me to speculate. I'm sorry.
It's just difficult for a lot of people in the game who follow the game to see how quickly things concluded with a club like Everton, and how long it's taking with a club like Manchester City. And some people can't help but conclude that maybe different clubs are being treated differently because of the status they have in the Premier League.
Yeah, well, I do understand the frustration and share some of those, but in the end, this process is very different. These allegations are very different.
What makes it different?
They just said the charges themselves and the number of them, but I can't really get into it. I really can't talk about it.
I understand you can't get into the details, but do you think it's hurting the reputation of the league?
Well, at the centre of this is a football competition, and I think people want to basically watch the football. That's the main event, and when you get dragged into whatever it may be, financial affairs, I think people think that maybe there's something going wrong here. I do accept all of that, but the competition remains strong, the economics of the Premier League remains strong, and fundamentally, as long as we can put the best players on the pitch and give people a fantastic competition, I think we can get through this period.
I've been an outsider, and I've been studying the rules of the game and the sustainability rule that kind of led to this investigation into Man City, and this idea that a club has to bring in and just spend the same amount of money that it brings in. Do you think that that rule has become outdated or unenforceable in any kind of real-time way?
So if you're talking about the financial regulations within football, our clubs are all really subject to two sets of regulations. Our own, the profitability and sustainability rules, and also UEFA's rules. So they're looking at two sets of financial rules to comply with. And essentially, in England, our rules are there. It's a spending rule, really, about profitability. So there is the ability to invest. And that's what we want our clubs to do. We've got a fantastic set of owners that invest in stadiums, in fan experience, and players on the pitch. And that's what we want. We have, as I said, a great set of owners that want to invest. And so there has to be a limit, ultimately, to ensure that we've got a competitive league, which we do have. So I think when owners look at investing in the Premier League, they can see that you can aspire to do better in the league. We're now seeing more clubs qualifying for European competition. Our clubs are incredibly successful in Europe. And that's all down to investment. So there has to be a limit, ultimately, on what you can spend. Clubs have all signed up to these rules, and we are enforcing them.
Well, how much does the Saudi League really kind of, I don't know, skew the financials of this in a way that creates a sort of complicated dynamic?
Well, the Saudi League is an investment phase. Saudi League's been around for many decades. Now we're seeing local investment into that, and they're becoming very active in the marketplace. Sometimes that's good for Premier League clubs. Sometimes they take players that Premier League clubs want to sign. It's just a new dynamic, and we have to observe it and we have to cope with it.
Richard, you've been generous with your time. We appreciate it. Thanks for dropping by.
Thanks for having me.
Thank you very much for being here. Richard Masters there, the English Premier League CEO.
This is the Bloomberg Surveillance Podcast, bringing you the best in markets, economics and geopolitics. You can watch the show live on Bloomberg TV weekday mornings from 6 a.m. to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.